Welcome to Stop Overcomplicating Your Money, the ultimate investing priority checklist. In this video, we'll simplify your financial setup so you can make smarter, faster decisions with less stress. We'll start with the big idea, simplicity over complexity. Then move through the priority order, time horizons, tax-advantaged accounts, and diversification. Along the way, we'll include diagrams, a practical plan, and a couple of quick quizzes. Let's begin, and then transition into the agenda so you know exactly what's coming next. Here is the agenda. Why simplicity wins, the priority checklist, emergency funds and HYSA, tax-advantaged accounts first including 401k, IRA, and HSA, time horizons and how they shape your asset mix, the truth about tickers and focusing on total return over dividends, practical diversification, consolidating accounts, a 7-step action plan, and 2 quick quizzes. With that map in mind, let's add a brief but important disclaimer before we jump in. This video is for educational purposes only and is not financial, tax, or legal advice. Everyone's situation differs, so consult a qualified professional before implementing strategies discussed here. With that responsibility note covered, let's move smoothly into why simplicity is so powerful. Many people create multiple investment buckets for every goal, which looks organized but quickly becomes hard to track and can lead to worse outcomes. Simplicity improves your ability to stick to a plan, rebalance effectively, and actually reach your goals. Now that the philosophy is clear, let's turn it into a concrete, visual priority flow. This flowchart maps the order of operations. First, build an emergency fund of 3 to 6 months of expenses in a high-yield savings account. Next, capture any free money through your 401k employer match. Then, if eligible, max the HSA. After that, choose between maxing an IRA or continuing to max the 401k, deciding traditional versus Roth based on your current tax bracket relative to your expected future bracket. Once tax-advantaged space is used, invest in a taxable brokerage using broad market index funds. For short-term goals under 5 years, route to cash equivalents like a high-yield savings account, or T-bills such as SGOV. For long-term goals of 15 years or more, route to global total return indexing, such as a U.S. total market fund, plus international exposure. Finally, consider optional extras, like a 529 for education. Review and rebalance each year. With the roadmap in place, let's zoom into the foundation, the emergency fund. Your first non-negotiable priority is an emergency fund covering 3 to 6 months of essential expenses. Keep it in a high-yield savings account rather than investing it. The point is liquidity and stability, not returns. Calculate your core monthly costs, automate transfers into the HYSA, and, if you ever draw from it, replenish it promptly. With the base secured, let's transition to maximizing the value of tax-advantaged accounts. Traditional 401k contributions give you an upfront tax deduction, which may be especially valuable if you are a high earner today. You will pay taxes on withdrawals in retirement. Roth 401k contributions are made after tax, and qualified withdrawals are tax-free, which can be advantageous if you expect a higher tax rate later. Many people benefit from tax diversification by using both, but prioritize according to your current versus expected future tax rates. Now that we've considered the account types, let's tie your investments to time horizons. Match your asset mix to your timeline. For goals under 1 year, use only cash-like instruments, such as high-yield savings or treasury bills. For 1 to 3 years, stay conservative with short-term treasuries. Between 3 and 5 years, introduce a small equity allocation coupled with bonds and cash. From 5 to 15 years, use a balanced growth mix. For 15 years or more, a growth-focused allocation with broad global equities is appropriate. With horizons set, let's clarify the truth about tickers and common misunderstandings. The headline is simple. Focus on total return rather than chasing high dividend yields, align your funds with your time horizon, and diversify globally. Let's unpack the dividend myth first, then move to diversification. Dividends are distributions of a company's profits and not free money. On the ex-dividend date, the share price typically drops by the dividend amount. In taxable accounts, dividends may trigger current taxes. The driver of wealth is total return, which includes price appreciation plus any distributions reinvested. Broad market index funds, such as U.S. total market or global funds, historically outperform strategies that chase single high-dividend ETFs over long horizons. Next, let's visualize diversification and a sensible core mix. This pie chart shows a simple equity core: 60% U.S. total market, 30% international, and a 10% small and mid-cap tilt. This is purely the equity sleeve. Depending on your time horizon and risk tolerance, you would layer in bonds or cash outside this pie to moderate volatility. Having seen diversification visually, let's discuss simplifying your account structure to make management easier. When it is not legally required to keep multiple accounts, consolidating into one well-diversified taxable account often simplifies your financial life. It streamlines rebalancing, tax loss harvesting, and record keeping. You will have fewer logins and fewer statements, which reduces the chances of errors. Maintain separate accounts only where required or when there is a compelling specific reason. To put all of this into action, let's move into a practical 7-step plan. Follow these 7 steps. First, compute your essential monthly expenses and set your emergency fund target. Second, open a high-yield savings account and automate transfers until the emergency fund is full. Third, capture your 401k employer match right away. Fourth, if eligible, max the HSA, and then use either an IRA or continue contributing to the 401k up to annual limits. Fifth, select a simple core portfolio such as U.S. total market plus international, or a global fund, and add bonds based on your time horizon. Sixth, consolidate taxable accounts where possible to simplify management. Seventh, schedule an annual review to rebalance and ensure you remain aligned with your goals. To reinforce the journey, here's a timeline of how this can look in your first year. This timeline outlines a pragmatic first year. In the first month, calculate expenses and open your HYSA. During months 1 through 3, build your emergency fund with automated transfers, while enrolling in your 401k and capturing the employer match by month 2. Between months 2 and 6, select your core allocation and consolidate taxable accounts. From months 6 through 12, work on maxing your HSA or IRA if eligible. At month 12, conduct a full annual review and rebalance. Now, let's test your understanding with a quick quiz. Question: before funding a specialized goal or vacation ETF, what should you prioritize first? Options: A. Buy a high dividend ETF for cash flow. B. Build a 3 to 6 month emergency fund in a high yield savings account. C. Put 100% into SCHD for the next 2 years. D. Open 5 separate taxable accounts for each goal. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You should first build a 3 to 6 month emergency fund in a high-yield savings account. This cash buffer prevents forced selling during downturns and reduces financial stress. With that foundation reinforced, let's continue to the second quiz question. Question: which statement best reflects this video's view on dividends in taxable accounts? Options: A. Dividends are free money that make you richer instantly. B. Dividends often trigger taxes now. Focus on total return instead. C. Price never drops by the dividend amount on ex-dividend day. D. Dividend yield is the only metric that matters for long-term success. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Dividends are distributions that can create current tax liabilities in taxable accounts, and the share price typically adjusts downward on the ex-dividend date. Long-term wealth is best pursued by focusing on total return. With the quizzes complete, let's cement the core takeaways. These are the key points. Keep your approach simple to enhance adherence and outcomes. Build your emergency fund in a high-yield savings account before investing. Prioritize tax-advantaged accounts in a logical order, typically beginning with the 401k match, then HSA if eligible, then IRA, or continuing 401k to limits. Align your asset mix with your time horizon, reserving safe instruments for short-term goals. Focus on total return rather than dividend chasing, and avoid concentration risk by diversifying globally. Consolidate taxable accounts where feasible, and perform an annual review with rebalancing. Now let's summarize the entire message succinctly. In summary, secure your cash safety first, then invest with purpose. Maximize tax-advantaged accounts. Let your time horizon determine risk rather than emotions. Choose broad, low-cost index funds and diversify globally. Simplify account structures to reduce friction and errors. Automate contributions and review annually. Finally, let's wrap up with a quick thank you and a call to action. Thank you for watching. If this video helped you simplify your investing priorities, please like the video, share with a friend who needs clarity, and subscribe for more content. In the comments, let us know the first account or step you plan to simplify this week. Until next time, stay focused and keep it simple.